Good morning from London. I'm Kriti Gupta alongside Tom McKenzie and Lizzie Burden. We're an hour away from the opening trade. Here's what you need to know. Fed Chair Jay Powell says the American labor market has cooled considerably in congressional testimony. Now, U.S. Treasury Secretary Janet Yellen adding that jobs are no longer driving inflation. Meanwhile, NATO ramps up its air defense support for Ukraine, with President Biden hailing it as a, quote, historic donation, as new assessments suggest the war with Russia is heading towards a stalemate. Plus, France's Socialist Party extends an olive branch to some lawmakers of Emmanuel Macron's movement. Political negotiations intensifying in the face of a split parliament.
Let's check in on the markets then, because European futures are, well, essentially flat. Well, 50 futures are looking a bit better than the Stock 600. You're looking to gains of around 0.2%. After the losses of yesterday, the handoff, of course, from the US, 6 consecutive days now of gains coming through for the S&P. That's the longest streak since January. FTSE 100 futures looking to add around 9 points. The US 2-year at 462. We have the 10-year auction later today. We'll see how well that is absorbed by the markets. The auction of yesterday was pretty well received. Euro-dollar at 108, currently flat on the single market, single currency, I should say, as we continue, of course, to keep an eye on the politics of France. The countdown to the opening trade starts right now.
Inflation has eased notably over the past couple of years. More good data would strengthen our confidence that inflation is moving sustainably toward 2%. The labor market appears to be fully back in balance. Labor market conditions have cooled considerably compared to where they were 2 years ago. We're well aware that we now face two-sided risks. If we loosen policy too late or too little, we could hurt economic activity. If we loosen policy too much or too soon, then we could undermine the progress on inflation. We continue to make decisions meeting by meeting. And the likely direction does seem to be in, as we make more progress on inflation and as the labor market remains strong, we begin to loosen policy at the right moment.
Fed Chair Jerome Powell, they're testifying before a Senate committee yesterday. And this is really interesting because, of course, we've been talking so much about the geopolitics, Tom and Lizzie, between the UK, the United States, France, and arguably other parts of the world as well. It feels like monetary policy has been a little bit kind of on the back burner, but we're bringing it right back into focus, not just because of his testimony, but because we have that CPI number on Thursday as well. And it'll be interesting to see how traders really position for this.
Yeah, and there's some lines crossing overnight around some of the trading in terms of the options markets, preparing for some of that volatility around the inflation story. But you're right. It kind of leads to that question. Is it central banks or is it politics that's most important right now for these markets? We get the additional testimony later today. It was interesting just how many times he talked about the cooling of the labour market, though.
Also interesting how much he talked about the bank capital plan. Looks like Wall Street could be close to a big win here, hence the gains for bank stocks yesterday. But, of course, it was also a very busy day in Washington in terms of, as you say, Kriti, the geopolitics. So you had that NATO summit, 32 world leaders coming to the capital, and obviously a huge moment of uncertainty for the alliance when you've got Biden's health under question. Macron and Scholz have their own political nightmares at home. Meanwhile, you've got Putin hugging Modi and the bromance with Xi. So, you know, Putin not isolated at all. Then you've got Starmer, the strongest leader in the room, surprisingly. What a change of events. And all of the impatience for him to set out his plan on when they're going to spend 2.5% of GDP on defence spending. A theme is Zelensky's impatience. When are they going to get the air defences? When are they going to, set out a plan for Ukraine to actually join NATO?
Yeah, this will be interesting as well. We're talking about the defense spending as well, but this was so much of a test almost on the international stage for President Biden as well. Can he hold his own with some of the folks, including the likes of Viktor Orban, for example, who's been making the rounds in other parts of Europe and Russia as well? Yeah, and has been admonished by the European Union for that, particularly given his role right now, Hungary's role, in terms of meeting with Putin and that kind of unofficial role. But you're absolutely right. The scrutiny, of course, on Biden, the scrutiny, of course, and overshadowing that NATO meeting to some extent, not just the question around Biden, but, of course, and this links to Biden, Trump, and what that would mean if a Trump presidency, of course, comes to fore in November and when he's in office in January, if that happens, what that would mean for that alliance, given his history of questioning US support for that. Others reports suggest, look, the spending has come through. 80% of the members now spending more than 2%. But as you say, Lizzie, pointing out the fact that the UK is being a little bit wobbly in this 2.5% commitment. To France as well. Macron was there. In terms of the
French politics, of course, and he's been undermined. He is a weaker political figure on the global stage right now. The most recent update, we continue the negotiations at a very glacial pace, essentially, in Paris around how this new government could form. The new assembly is going to be taking place in a little over a week, and then you have the budget that has to come in September. The socialists have been reaching out to Macron, and that could be the least bad scenario for these markets. So I think that's really important. Their chief negotiator reaching out to Macron's Ensemble party and saying, let's try to put together a coalition. There are some things on which we can agree. That could be the least bad scenario, trying to carve out, push out the left, the extreme left and the extreme right. But, of course, there's still lots of uncertainty there.
And how does that show up in the markets then? If the narrative here is the deficit story over and over and over again, SocGen, for example, coming out, a major French bank whose shares have, of course, been hammered, the intelligence part of that saying, well, there's maybe a new equilibrium when it comes to that spread, somewhere between 60, 75 basis points.
Yeah, but if you have a coalition between the centre and the centre-right, which is what Emmanuel Macron's former Prime Minister Edouard Philippe is trying to rally together, you could ask whether that would find it easier to agree on fiscal policy, and then what is that premium on gridlock?
All right, plenty to discuss there. But first, as we kind of talk about just all the things we're digesting, let's talk about some of the other things we're talking about on the show today, because we have a great lineup to walk you through everything that's going on. Nicola Mai, for example, will kick it off there from PIMCO, joining us shortly as well to talk about just that spread, exactly what we're going to be watching, plus how that shows up in other parts of the market, from the bond market to the stock market. We've got you covered. Christian Muller-Glissman from Goldman Sachs will join us as well. And then we go right back to that fiscal policy story as well. Of course, as the new UK government gears up, we speak to the CEO of the Green Finance Institute. She is leading the National Wealth Fund Task Force, looking at where the new government should be investing over £7 billion of public funds and whether or not it's enough to meet those ambitious goals. And later, of course, we'll discuss European politics and the fallout of the French election result. Former Italian Prime Minister Matteo Renzi been very vocal, Tom, about the potential strength of Biden on the international stage. He'll join us perhaps with his take on how things are going in Italy. Yeah,
a political centrist. So what all that means in terms of the political shifts that we're seeing, the sand shifts in Europe, and his view on that will be really fascinating, won't it? Given he has that touch point, of course, across the politics of Italy and his experience. To France now. Let's get the latest and bring in Bloomberg's Paris bureau chief, Alan Katz. Alan, where do we stand in terms of these negotiations? Are we any closer to getting a government in France?
Well, you brought it up earlier. There is the socialists who have reached out to Macron's party, but don't forget that the socialists are still within something called the New Popular Front, and they've said they want to remain in that, at least for the moment, as they try to come up with a potential prime minister candidate to offer up to Emmanuel Macron. So that would include the Greens, the Communists, and the far-left France Unbowed party. At the same time, as you mentioned, Edouard Philippe, the former prime minister, has reached out to the right. That's where he comes from originally, from the center-right Republicans. And some center-right Republicans are reciprocating that reach out, but not all of them. And even if you added up, say, the socialists plus Macron's sort of centrist group, or Macron's centrist groups and the right, you still don't get to an absolute majority. So we're relatively far away, I think, from any sort of deal. And if you listen to people, they say, oh, it'll be a matter of days or weeks. And they keep saying that or weeks part of it because we're really just not close to any sort of deal or any sort of conclusion yet in France. And we're still far from sort of any stable form of government. Again, France doesn't really have this history of coalition governments. They're not good at minority governments, and they're not good at coalition creation. So it looks like it's going to take some time for this to go forward.
Well, Alan, at the same time, I'm curious, even though we are away from that kind of clarity of what that government actually looks like, I'm curious if we can kind of jump ahead to the policy discussion, simply because we know, of course, the deficit is on top of mind, both economists and markets alike. Do we start to see more moves, even from Macron's own government, to address that growing deficit? Even though it may not be speeding up, it is still growing.
So probably not, actually not in the near term. So the deficit is actually a little bit better than they previously expected. It sort of got covered over during the chaos of the election, but they actually have a little bit higher tax receipts in the first part of the year than they expected. So there's a tiny bit, not much, but a tiny bit less pressure on the deficit. But the reality is the current government is essentially a caretaker government, and it's probably going to formally resign before Thursday of next week. So that way the government ministers who were elected as members of parliament can actually sit in parliament. But it's really a caretaker government. It's not going to implement any major policy changes, before a new government is formed. That would be seen really, I think, by the French public as a real slap in the face. You call elections and then you continue acting as if nothing had ever happened. I really think that's not going to happen. And plus, there's no sort of urgency to do so, whether it's the EU excessive deficit procedure or the French budget. Those come to a head more in September and October, not over the summer. So for the very near term, there's really not any pressure to sort of do anything big, at least, by the French government.
OK, Bloomberg's Paris Bureau Chief Alan Katz, we thank you for the latest on that horse trading in France and how it affects the markets. But here's what else you need to know this morning. Other corporate stories. VW is cutting its margin outlook for the year. The German car maker reduced its guidance to as much as 7%, down from a previously predicted high of 7.5%, citing costs related to a potential Audi plant closure in Belgium. It's after disappointing demand for some EVs and other unplanned expenses. Meanwhile, Europe's Ariane 6 rocket launched to orbit during its long-awaited debut yesterday, but suffered a problem in space, cutting short the mission just before a key test milestone. The rocket thundered off a launch pad in French Guyana on the northern coast of South America at 8 p.m. London time. It's the centrepiece of Europe's space ambitions and key to proving that an old-fashioned, one-and-done launcher still has place in an industry increasingly dominated by reusable vehicles. And elsewhere, Samsung's largest labour union has declared an indefinite strike. The surprise move raises the risk of production disruptions at the world's largest memory chip maker as it fights to catch up in the AI race. The call by the union, which represents more than 30,000 workers, coincides with the conglomerate's biggest product launch of the year in Paris. It's the largest organised labour action in the half-century history of South Korea's biggest company.
OK, staying on Samsung, you mentioned this, Lizzie, as well. 2 p.m. UK time, you're going to get that unveiling of the latest devices from Samsung. Intriguing timing, of course. That's going to happen in Paris. Intriguing time given the strikes that Lizzie just detailed for us in South Korea, not in Paris. 2:30 p.m. UK time, we're going to be hearing from the BOE chief economist, Hugh Pill. Going to be really interesting, given market expectations that maybe the August cut is in play for the Bank of England. And at 3 p.m. UK time, talking of central banks, Jay Powell continuing that testimony, this time before the House Financial Services Committee. Given what he said about the labour market yesterday, it's going to be interesting to see whether he will be pushed again on the timing of the first cut coming through from the Fed. And at 6 p.m. UK time, $39 billion of US 10-year bonds will be auctioned. There's an auction yesterday, relatively well received by the markets. We'll see if that continues today. 8 p.m. UK time. I should get the studio team's take on this. Euros semi-final, England versus Netherlands. I think John from the studio team was telling me he thinks it's going to be 3-1 to England in the semi-finals. But before we go there, Spain, France, what a match. Obviously have to bring in Criti at some point, but very briefly, the youngest goal scorer of the tournament, 16 years old, from the Spanish team, of course, Lamine Yamal. And I want to read this from The Guardian, because the write-up in The Guardian on the back of this match is fantastic, from Jonathan Liu. This is a quote. Indeed, to anoint Spain as worthy finalists is to damn them with crushingly faint praise. In a way, they have made this tournament, perhaps even saved it, shown that amid a fat berg of low blocks and tired, malfunctioning attacks, it is possible for football to express as well as extinguish.
These are fighting words. These are aggressive.
That's
words.
your Spanish team right there.
That's not how I would characterize it, but I thought it was a great match. To your point, the 16-year-old getting the first goal from Spain, and then France having an own goal as well, which was disappointing for France, but I'm very happy as a Spanish supporter as well. I think especially in the year thinking 3-1, England-Netherlands?
Yeah,
really?
I'm feeling optimistic, yeah. And then we're going to face Spain.
I'm so proud of you, Criti, that you've adopted football as your new passion, having moved to London.
Oh, I've always been into football. Whenever Spain's involved, I'm involved, and I think that's the way to go. Unfortunately, some of our producers have a going bet on France, and sadly they lost out on that. So our sympathies to that team.
OK, here's to a Spain-England final, because that chat will be fun on the back of that. Criti, OK, the latest on the football. Our UK Spain football correspondent. Criti, you've got a little bit more in terms of the teas coming up for us. Focus on Boeing, maybe.
I'm so excited. I got to say, finals coming up on Sunday. We're going to dive in. This will be our top story on Monday, absolutely. Coming up on the program, though, we're going to get back to the actual news. Boeing getting a boost as it delivers the most aircraft since the company curbed work in its factories following a near-catastrophe incident involving its 737 MAX jetliner. We're going to bring you the details. Plus, of course, your stocks to watch, including Volkswagen, after the German automaker cut its forecast on a potential plant closure and disappointing demand for some EVs. If you, of course, have any questions or of our guests or of your own for us, please send them to us on IB plus BBTV Go. More ahead. This is Bloomberg.
With gridlock, of course, you're not going to make progress on reform because nothing is going to happen there because you can't get agreement. But similarly, the more extreme scenarios that were being talked about in some cases before the election of fiscal expansion are not going to happen. I mean, if you look at the Nouveau Front Populaire, some of their proposals were 2 trusses of uncommitted, unfunded spending.
UBS's wealth management's Paul Donovan speaking to the program at France yesterday, characterizing it as 2 trusses, of course, referring, I should say, to the Liz Truss drama of a couple years ago. Let's bring in another voice here. Rhian-Mari, sovereign credit analyst in the portfolio management group over at PIMCO, joins us right here on set. Good morning. Pleasure to have you around the table. It's so funny that we're talking about a Liz Truss moment and we're kind of using it as a verb almost. Is the French bond market having a sustainable Liz Truss moment? How long is this going to last?
Well, I think we're on for a period of political uncertainty. I mean, what I do think is that we are probably not going to have an extreme administration ultimately. I think Liz Truss really pushed, the fiscal levers, very aggressively. I think right now in France we're going to have a weak government, a minority government. I doubt that they're going to be extreme from a fiscal perspective, partly because they don't really have the numbers to push extreme measures. It's going to be a fairly weak government.
But I'm curious about how this shows up in the bond market here. Guest after guest on this program has talked about how France has almost seems like an inferior credit in some ways to the likes of Spain, to Italy, et cetera, whether that's fiscal spend driven or deleveraging driven, kind of pick your periphery country to compare it to. And yet, if you look at the bond market relatively performing, you're not seeing that show up in the trade. Why not when that's what the narrative is?
Well, I think that if you look at the deficit in France, it's certainly very wide. So debt is on an upward trajectory. Obviously, the level of debt is still well below Italy's, for example. But I think the reason why the bond market is not too stressed is that ultimately whoever is in government is probably going to broadly meet the Commission's demands when it comes to the deficit. So you're going to see some gradual deficit reduction, probably not as fast as Europe demands. But I wouldn't expect a fiscal splurge here. And I think the market's pricing of 10, 15 basis points of extra spread relative to the pre-election announcement is not unreasonable here.
So you're comfortable with the spread and the pricing right now in terms of the political risk of France. And to be clear, you don't put them in the same category, sovereign debt of France right now, as Italy and Spain. Just to be clear, you're not doing that.
Well, I think that, relative to Italy, the debt level is significantly lower. So I think some extra spread in Italy is fair.
Okay.
I think when it comes to Spain, I think the two are more similar. But I think they all suffer fiscal challenges in different forms.
Okay. You like the UK. You like gilts. Which part of the curve?
I like the 5-year part of the curve especially. I think the UK, to me, if you look at the curve of the UK relative to the US, for example, the Bank of England path priced in the market is basically right on top of the Fed for an economy that has been a lot weaker, where the labor market has shown clear signs of weakening, where neutral rates, equilibrium rates, are most likely lower than the US, and importantly, where fiscal tightening in coming years is likely to be present. I mean, this government is going to be quite orthodox. So I think I like duration here. I like gilts. I think 5 years is a good place where to take exposures.
Well, they're being very careful at the moment, but what about later down the line, maybe a second budget? Do you think the bond vigilantes would forgive a looser fiscal policy from Labour?
Well, I don't think policy is going to be looser, really, from Labour. I think their plans are quite conservative, and I would expect, if anything, some fiscal tightening. I mean, you spoke about the Liz Truss episode being a term in itself, and I think the UK is still mindful of this experience, and I think all the comments by Michelle Reeves, the new finance minister, the plans of the Labour government are quite orthodox when it comes to fiscal.
And what would stop the Bank of England handing Keir Starmer the first rate cut after the next meeting, basically?
I think there's a good chance that the Bank of England will cut in August already, if not September. The market is broadly pricing that. I don't think the Bank of England is going to get into politics. They're going to cut when macro warrants it, and I think we're getting to the point where that's the case. I mean, UK inflation has been a lot higher than elsewhere, but I think it is slowing, and the labour market weakening should raise confidence in the fact that inflation is moving in the right direction.
Can we talk about the liquidity picture for a moment? I want to say a couple weeks ago, it's starting to see a lot of headlines, a lot of analyst notes, especially about liquidity kind of drying up a little bit. Drying up is a strong term, but just cracking a little bit, especially in the U.S. Treasury market. Now that we're seeing such open interest right now in the French market or even in German debt as well, I'm curious what a liquidity snap might actually look like. When would we recognize a sign of that?
Well, I think liquidity is really important. I mean, we saw signs of lacking liquidity, obviously, during the pandemic in the Treasury market, and I think central banks are mindful of that. And, you know, the ongoing quantitative tightening programs, you know, do raise some risks that over time you're going to have some liquidity events. At the moment, I wouldn't be concerned. In case central banks were to witness that, I think they would take the appropriate actions. But obviously, I guess what we would be looking at is just sovereign debt markets, repo markets, you know, I guess the usual signs of liquidity strains. But again, I would imagine that central banks would intervene if that were needed. So
let's bring that right back to the French story as well. If you look at the Eurex clearing data, for example, I get very nerdy into market plumbing, as you can tell. There's so much open interest in French debt right now, even though the situation does seem to be calming. Gridlock is supposed to be a favorable outcome in France. Why that open interest? Why so much exposure in the fallout of this?
Well, I think, I mean, I don't have a very clear view on that. I think that the situation is fairly calm, but I think that obviously this is a market that is quite liquid and it's widely traded. There's a lot of foreign investors in the French market, and yeah, I mean, I would imagine that this is a situation that would attract risk-taking.
On the US, where are we? As we start at markets pricing in like 70% chance of a cut in September. We'll be listening out to what Jay Powell's to say later today. After that, focus on the labour market. What, in terms of when you think about the disinversion of the yield curve and the timing for that, what is the catalyst for that? When does that occur? Because we've been in this inverted yield curve for, 2+ years?
Yeah, look, we're positioned for curve steepeners. I think an inverted yield curve is not a normal state of affairs. I mean, normally investors need to be compensated for taking duration risk.
Yeah.
And so I think we're going to have a normalization of the curve. Exactly when we're...
This year, you think?
I think this year or early next year, yeah, we should be getting to that, you know, to that kind of disinversion of the curve for a couple of reasons. I mean, first of all, rates should start to fall.
Yeah.
And also, I think the long end of the curve is going to be pushed up, or is going to remain high on fiscal concerns and the central bank balance sheet reduction. So I think we should be getting that over the next couple of quarters.
It's interesting, you've been prescribing a reversal of the 60-40 portfolio split. We're going to be speaking to Christian Muller-Glissman from Goldman later, who's defending it. He's written a piece in the FT recently, but you're still for the reversal of it. Just briefly.
I would say so, for sure, in the sense that, look, I mean, equities have been doing very well, there's no doubt. But if you look at current equity valuations, to us, they look quite stretched, and they've been bolstered by high expectations on artificial intelligence, which in our mind may be excessive in light of previous tech breakthroughs, for example, taking longer to deliver productivity. And at the same time, yields at the moment are very high in bonds. Yeah. You can easily get 6-7% with very safe assets, and yields are very correlated with returns. So to us, you want to shift that 40 a bit higher.
All right, Nicola, my sovereign credit analyst at PIMCO, we thank you, as always, for coming on the programme. And coming up, we're going to talk about Boeing, just delivering some good news as the troubled US plane maker handed over 44 aircraft in June. We'll bring you the details next. This is Bloomberg.
We are 30 minutes from the start of the opening trade. There's a lot going on we need to know in terms of geopolitics. Of course, we have the NATO summit going on or happening in Washington. We are waiting for the fallout here in the UK and in France as well in terms of what the new policy direction may look like from the newly elected governments on both sides of the English Channel. In the meantime, though, our eyes on the markets after Chair Powell's testimony. CPI on Thursday. Futures looking higher, but not that high. Nothing to write home about. Not that much excitement, which is when we start to do a quick check on the bond market as well. Remember, we still have our eye on the French bond market and whether or not that yield compression is going to continue. SocGen, for example, saying a spread between the French and German Bund market, debt market. I'm going to get my words right here. They're talking about a new equilibrium, 60 to 75 basis points. Right now, you are seeing a bid across the bond market, but again, not a massive one to instigate some sort of narrative. We're going to keep our eye on that. In the meantime, let's get a quick check on our corporate news here. Finally, some positive news, I would say, when it comes to Boeing, as the U.S. plane maker hands over 44 commercial aircrafts last month. It is the most since the 737 MAX blowout in January. Monitoring this very closely is Bloomberg's global aviation editorial leader, Benny Kamel, joining us this morning from Berlin. Benny, walk us through the context of these numbers.
Yes, good morning from Berlin. You're right. Good news and Boeing aren't words that have gone sort of hand in hand in the last 6 months. A lot of bad news coming out of that company. But finally, something for investors to cheer about. You mentioned it there, 44 aircraft that were delivered in the month of June. So that's the first half behind them. But if you compare that to Airbus, who came out a day earlier, there's still quite a delta between the two of them. Airbus delivered 67 planes, which in itself is also good, but there's room for improvement there on both counts. Normally, these companies deliver quite a few more aircraft. And the bigger picture here really is that they're both struggling with their own specific issues. Airbus has supply constraints that are preventing it from pumping out these planes in the numbers they'd like to. Boeing, meanwhile, has a lot of issues of its own, chiefly the regulator sort of slowing down the company in terms of what they can do, and Boeing saying, we don't actually want to produce that much right now because we need to get our factories in order. So really the question is, what will the second half look like for both companies? Will this positive trend that we saw in June continue?
Exactly, and what are the major hurdles to overcome, Benny?
Well, the big issue really for the company is who's going to run the company into the next year and obviously beyond. Dave Calhoun, who's the CEO, the embattled CEO, he has said he will step down by the end of the year. So we have that transition period, and that gives the board a little bit of breathing space to find the right person. Who that might be, we don't know at this point, but it'll have to be somebody who can sort of fix Boeing in more ways than one. He has to fix the factories, he has to fix the relations with airlines, he or she has to fix the relationship with regulators. All of these things are badly sort of bent out of shape, if not broken, so that's a huge task waiting for whoever takes over that job next.
Benny, what are you watching for, you and the team, in the second half of this year in terms of how this sector moves forward?
Yeah, sort of the big marker for us is the Farnborough Air Show that happens in about 10 days towards the end of the month. That's south of London. It's usually a big check-in to sort of feel the pulse of the industry. What's the order momentum like? Who's buying aircraft? What types of aircraft are being bought? A lot of executives will be there. Interestingly, Boeing's not bringing over any aircraft of its own this time. Usually you have this fairly grandiose flying display, but Boeing has said, we're too busy basically getting our planes over the line, getting them certified and so on, so we can't really afford to bring them over here to the air show. So sort of a new, smaller, more humble Boeing, shall we say. So it'll be interesting to see how Airbus plays out in that market. But really, the story is, what will the recovery look like in the latter part of the year and beyond after a very difficult first half for both plane makers?
OK, Bloomberg's Benny Kamel, who leads our global aviation coverage. We thank you for the latest on Boeing and the outlook ahead. And we're going to stay on transport but pivot to cars, because Volkswagen has cut its outlook for the year, warning that it may close its Brussels plant as low electric vehicle demand has hit its Audi division. Let's get more on that story with Bloomberg's transport reporter Danny Lee. Danny, what does this mean for VW?
Well, when you look at the numbers and what it's announced, its operating margin on sales is being cut to 6.5% to 7%, and that's down from 7 to 7.5%. And so they put this bleak backdrop on, pinning it on the battery electric vehicle sales, where, as we see in Europe, demand is weak. And so there is a bit of a struggle there, not just for VW, but for the likes of Mercedes as well, another big German rival. So the picture is not unique to VW alone, but in this set of circumstances, not just the margin outlook being cut, but there's also extra expenses being added to its bill to the tune of 2.6 billion euros. VW is not necessarily specifying what exactly that increase is, allocated or accounted for, but it'll be really interesting to see when it reports earnings on August 1st.
So within that earnings picture, Danny, what are you going to be looking for? How does this set them up for that earnings story in the second quarter?
I mean, when you look at its outlook, the estimates we see for its operating income into the second quarter, it's still fairly robust to the tune of 5.8 billion euro. And when you look at how it performed in the first quarter when things were a little bit weaker, they actually cut their profit dropped by 20%. So that was not a great sort of state of play. But as we see further concerns in EV demand, you see other brands adjusting their strategy, and potentially there could be more companies tweaking. There is this risk of a write-off on some of these battery electric vehicle assets, but when you see Volkswagen, they're going very full-throated into its investments, as we've seen with them investing in the likes of Rivian to the tune of $5 billion in the US. They've still got their investments out in China. So they're taking a big punt on EVs, but not necessarily going down traditional route itself, clearly to try and catch up and to embrace China in some regards, but to have a foothold where it can't necessarily play on its own.
Danny, on China, how should we be thinking about the kind of competitive threat right now? There's a really interesting story that crossed a day or two ago about BYD signing a deal in Turkey. Is that how Chinese automakers are going to be looking to get around these tariffs? They build out manufacturing facilities in countries that are not impacted by those tariffs, and they can continue to ship into the European market. How much of a challenge is that? To what extent is that going to be the new normal for Chinese EV makers?
Yeah, I think it was interesting for BYD, the fact that it is continuing its investment push, this $1 billion in Turkey. There's been reports out that it could also invest in somewhere as far afield as Peru. There's also a further capital commitment it has made in its headquarters of Shenzhen. So there is a lot of momentum for the likes of BYD. And it was actually fascinating that when you look at how VW is responding to the EV market, we had JP Morgan out with a note that BYD, which sold 3 million battery electric vehicles and hybrids in 2023, it could actually sell 6 million by 2026. So you can see that challenge that BYD is coming to the likes of VW and Mercedes and into the likes of Europe, although tariffs are still a question for the likes of BYD in the short term.
All right, Bloomberg's transportation reporter Danny Lee walking us through the nitty-gritty of the VW story and what that means for the broader navigation of some of these EV companies. We thank you so much. Coming up, we go from the transportation sector to more on shipping. We're going to look at your stocks to watch at the open, including Hapag-Lloyd, after the shipping giant raised its forecast for the year. The details next. This is Bloomberg. We are less than 20 minutes away from the opening trades across Europe. A little bit of positivity when you look at the futures picture. Just take a look at the green in the screen you're seeing across the board. Your Eurostoxx 50 futures higher by 0.3%. Remember, traditionally in the last couple of days, with that geopolitical overhang, we have had a little bit of risk-off sentiment at this time of day. And yet, this morning, a little bit of buy-the-dip mentality. How much of that is a reaction to what we saw in the U.S. session? That's going to be something we keep our eye on, specifically when it comes to the French and German indexes. How are they reacting to that political landscape? In the meantime, though, while we're waiting for those markets to open, we are, of course, going to keep an eye on some of the other dynamics driving the monetary policy, which brings me to a chart that caught my eye. We heard plenty from Chair Powell about the inflationary story, that jobs, for example, no longer driving the inflationary story in the States. But what about from the rest of the world? And that's really where I want to go next, specifically with a specific chart on Chinese CPI. This is really important when it comes to the idea that inflation may actually be either imported or deported from Asia. And this is significant because, of course, the Chinese deflationary story was a big one, Tom, a couple of, I want to say months ago, arguably. Kind of feel like it died in the narrative. The idea here simply being the higher prices in China or even lower prices in China could help ease the inflation story around the world. But now you're starting to see slight, I emphasize slight, tick up in this Chinese CPI story. I'm curious what that means for that deflationary story and whether or not it's even relevant to the other parts of the world. Tom, I'll leave that thought to you.
Yeah, we should break open, shouldn't we? Break apart to what extent it links into global inflation, because that's a really important point. But essentially, the narrative has not changed. The data hasn't really significantly changed on China and the disinflation or the lack of inflation in that country. Such a different picture versus what we're seeing, of course, in Europe, the US and many parts of the rest of the world. They cannot get prices to that 2% target. And a lot of this comes down to the Fed in terms of their ability to act. So inflation's very low. So on some levels, you think, OK, so you can ramp up stimulus. The risk for them is you see massive outflows in terms of selling pressure on the yuan. We've already seen weakness there. We've always seen record flows into Chinese bonds. So they're slightly cornered by that until the Fed can cut. So they will be looking with a keen eye as to what the Fed's next step is. If you get a cut from the Fed in September, that could ease some of the pressure. Then the stimulus comes through, and that will pay off for those markets and those investors who have really bought heavily into Chinese bonds.
Those record flows into Chinese bonds is so crucial as well, because it's coming as you start to have a foreign demand question for U.S. Treasuries in particular. And I think that feeds into, we were just talking this with Nicola Mai, but the liquidity story in the sovereign debt markets that you're seeing in both Europe and the States as well. And the fact that you are seeing the liquidity picture and the digestibility of some of these auctions in the States, it gets really nerdy very quickly. And I wonder how much of that is foreign demand. We don't have the data to crunch it, but there is a speculation right now in the market that that kind of trade-off very much exists.
Yeah, and then it brings it back to the politics, right, in the US, what the tariff story is going to be if you have Donald Trump back in the White House. Interesting to bring it back to the central banks and look at the Bloomberg Economics reaction to this inflation data out of China. They do say that it reinforces the need for stimulus and may compel the PBOC to cut its one-year rate in September. So to tally all of those rate cuts that we're seeing around the world, it brings us back to the Fed versus, again, the Bank of England, as we were talking, and where you see the impact on currencies. Because in the UK, of course, you still got the pound resilient despite the expectation that the BOE is going to go before the Fed, which brings us back to Nicola.
Yeah, Nicola, and the call on from PIMCO on gilts and wanting to be sitting in the belly of the curve here in the UK and wanting to be added to 5-year gilts. He thinks there is an opportunity there as he expects that cut to come through from the Bank of England and a relatively constrained fiscal picture from this new Labour government. You raised the question as to whether or not that is sustained going forward, longer term for the Labour government. But certainly that was the call from him, sitting in the 5-year and wanting to add there in terms of UK gilts.
And we were talking about the U.S., the BOE. We're talking about the ECB as well. We threw a little bit of China in there. We should also talk about the RBNZ. And this is significant because this came out overnight, seeing some weakness in the Kiwi as well. And I'm curious about the fact that not every kind of central bank is on the same page here. We're no longer looking at Chair Powell being not only the Fed chair and the governor, the central bank governor to the U.S., but potentially central bank governor to the world. It feels like, Tom, that narrative has completely died.
Let's get the call then and the take from Paul Dobson, and he'll be touching on that RBNZ story. As you say, important, Critty, to unpack what's happening there in terms of the narrative more broadly when it comes to that part of the world. Paul Dobson, our executive editor for Asia Markets. Paul, let's start on what we've been hearing from Jay Powell then and look ahead to the CPI data on Thursday. What is your take? My sense was, listening to Powell and going through parts of the transcript, that this is a Fed chair who is leaning dovish.
Yeah, and it certainly feels like that. I mean, for a while he's been talking up the possibility that the job market could start to slow down a little bit more aggressively, and that was a long-term radar worry 3 or 4 months ago. And when we listened to him yesterday, he started to talk about that a little bit more, saying there are definite signs of that slowdown in the labour market, and saying that I wouldn't have made that observation 2 months ago. So a relatively recent phenomenon that the Fed is starting to pick up on, the governor, the chair is starting to latch onto and highlight a little bit more, saying that's not the only thing that we're paying attention to. Inflation too, but, you know, the two of them stand side by side. So it did feel like it leaned a little bit dovish. On the other hand, the market wasn't particularly shocked by it, judging by the reaction, because we didn't really get very much move off the back of that in treasuries at all. Maybe a tiny little bit of steepening of the yield curve, but nothing too pronounced. So the market's still looking for those 2 cuts sometime this year, leaning a little bit more likely towards September, but nothing too powerful or conclusive from that. So all eyes on that inflation data later in the week.
When we're talking about that inflation data, though, there was some analysis coming out of J.P. Morgan that said that this was actually going to be the data point that resulted in far more volatility relative to some of the other data points, including the testimony from Chair Powell as well. I'm curious how much of this data print really changes the dial on this disinflationary narrative that we're hearing.
Well, let's see what it says, of course. But I think that every one of those inflation readings, whether it's the CPI, whether it's the PCE, the market is watching very carefully for what it's telling us about how quickly inflation is coming down and how much leeway the Fed now has to move. And I don't think that, forecasters have really managed to nail it all that much in terms of predicting what the data are going to show. And so every time we get one of those numbers, there is that propensity to give us a little bit of a shock. And so maybe, that's why the market price is in so much volatility around there, because it does seem to be a little bit hard. I think people understand the trends, but a little bit hard to figure out exactly what each data point along that process and path is going to tell us.
And Paul, you talk about the inflation data in the US. In the UK, of course, we've got inflation data next week before the BOE decision in 3 weeks. And yet the pound's resilient with the background expectation that the BOE is going to go before the Fed. How long does that hold up?
Yeah, I think we're going to watch out for it, particularly pound against the euro, an interesting cross there, as well as the pound against the US dollar. It's going to be crucial to hear what the BOE speakers tell us before we get to the inflation data. We get Hugh Pill, I think, coming up this today, and if he leans into the more dovish comments that he's been making more recently, coming back out of the election quiet period, then that's going to be quite telling, I think, for market observers who are expecting, potentially that shift in the voting dynamic from the BOE as we get towards the rate decision for August, likely to be closely watched and carefully monitored. So that's going to give us a lot more of the direction for the pound. With the election out of the way, we're in relatively safe territory, at least as far as political risk is concerned. One less thing for everybody to worry about. And I think, can continue to watch as well those yield spreads for direction.
In the meantime, strengthened cable off the back of that. Paul Dobson, our executive editor for Asia Markets, we thank you so much for joining us this morning. We're going to go from the macro to the micro and get our stocks to watch with Joe Easton. Joe?
Morning, Critty. So we've got a bit of a guidance downgrade from Volkswagen today. This is related to the closure of a plant over in Belgium that was making one of their electric vehicles that hasn't been selling particularly well. This is the Audi Q8 e-tron, which has seen poor demand, according to the company. So they cut their forecast on this closure and also see added costs of around 2.6 billion weighing on the result because of this plant shutting down. As I say, that's triggered by the poor demand on that vehicle. Now, this has been a bit of an underperforming stock versus the broader autos index this year. We can see that on the chart. Volkswagen, the orange line down here, and the autos index up here. That has suffered from weak demand for other EVs, including Chinese demand weighing on the company as well. So again, looks like negativity. Some analysts saying, though, that this is potentially already priced in, given that underperformance. Then we're also looking at shipping stocks today. Hapag-Lloyd over in Germany giving a really positive update, upgrading their earnings guidance. A pretty decent earnings guidance upgrade as well of about €1 billion for the full year in terms of their EBITDA. This is, of course, driven by the shipping rates. We can see that this stock has rallied since the back end of last year, given the Red Sea disruption pushing up those rates. That has been the key theme for this sector. A little bit of weakness that we've seen recently. But the cost of moving goods around the world has risen dramatically, as we can see from this chart. This is an index that tracks the price of moving goods from China to Europe, the US and other regions. We can see it up 280% over the last year, given the attacks by the rebels over on the Red Sea that did push up the freight rates. And these are the other stocks to watch in terms of a read across today. Maersk came in over in the Swiss market, DSV in Denmark, and also Frontier, the oil company that moves oil around over in Norway as well. All of those could get a positive read through today. Then in terms of analyst ratings, traders telling me that this one is going to be a market mover today. IAG double upgraded over at Morgan Stanley. Now, Morgan Stanley has a model looking at capacity in long-haul travel and pricing. They say that capacity is still constrained and IAG is most exposed to this, so should see the best price rises. They double upgrade IAG to overweight and they downgrade Lufthansa to underweight today, changing their preferences on these two companies. Lufthansa has been a bit weak recently. They cut their guidance given some issues with strikes and industrial action. There it is on the screen again. There, Lufthansa, the white line. We can see it already underperforming IAG. So Morgan Stanley perhaps catching up with that. And if we look at the IAG ratings, we can see there is not a single sell rating on that. It doesn't get much better than that. 24 buys, holds at 7, not a single sell. IAG could get a boost this morning.
Yeah, that gap in performance from IAG versus Lufthansa is quite significant, isn't it? Morgan Stanley a bit late to the party in terms of IAG? Don't know. Joe, thank you very much indeed. We'll bring you back, of course, in the next couple of minutes in terms of how those stocks are moving. It's going to be interesting. Commodities under a bit of pressure today, guys, as well. In terms of copper, iron ore, that ties into the China story, some softness there. Continued details, of course, around the inflation or lack of inflation story. So the miners in the UK may be hit as well.
Yeah, a lot to digest there, and Volkswagen, I think, is going to be front of mind in terms of what the read-through kind of is to some of the other kind of EV players as well. He mentioned the shipping story. Of course, there is that one there as well, but we're going to be looking at the impact of the hurricane as well. That's been an ongoing overhang over in the States, specifically around the shipping lines and how they have to navigate. Yeah, interesting also to watch Wetherspoon and Barrett developments in the UK, specifically stocks here after their results this morning. Just a couple more to watch at the open. Yeah, there's a lot going on, but I think we're still waiting for the kind of whether this is a buy the dip mentality, whether or not we're going to see this green on the screen in futures actually last into the open. Of course, you are seeing a little bit of outperformance over in France and Germany, but we are going to see again if that continues. Looks like it's building up as we get closer and closer to the open. We're going to break it down for you next. So ahead, we've got the opening trades across Europe. This is Bloomberg. A few minutes to go until the opening trades across Europe. You are seeing perhaps a little bit of positivity, but here's why. It must be coming off of the moves that we are seeing in the last couple of days. Or the last two sessions, I should say, specifically when it comes to the European session. The blue line here is how we saw the Stock 600 actually end. A lot of fading going into the end of the session, of course, ahead of Chair Powell's testimony, only for the U.S. to continue that narrative. So given the fact that we actually ended the day lower in both sessions, may be significant, Lizzie, for what we're seeing in the futures trade. Indeed, we're looking at futures on both sides of the pond pointing higher this morning. Eurostoxx 50 futures higher 0.3%, FTSE 100 futures higher 0.25%. Same for CAC 40 futures in Paris. You did have that buoyant optimism about Fed rate cuts in the session, and we're seeing more optimism this morning. Tom, you're looking at the individual stocks to watch at the opening trade. Yeah, as you say, the futures picture looking quite bright, up 0.4%. We're going to be looking at Hapag-Lloyd, we're going to be looking at VW, we're going to be looking at Rio Tinto. The miners as well could come under pressure. Copper and iron ore prices are softening on the back of some of the data out, of course, of China. VW adjusting its forecast in terms of the demand picture for EVs. They've also had some problems around one of their factories, so that could be a challenge with the Audi brand in focus. Hapag-Lloyd, though, very different picture for this shipping company, raising its forecast. Could get a pop in shares for Hapag-Lloyd. Could be a broader read across the shipping market. And as I said, Rio Tinto, part of the mix in terms of the miners, given the sell-off, or at least the pressure that's coming through for the likes of copper and iron ore. You had inflation in China, 5 straight months, essentially a zero in terms of CPI. Producer prices, factory gate prices falling by 0.8%. The real estate crisis has not been boxed away yet in China. So some of the individual names that could be on the move in the session. Critty. And what is the rate they're going to be into that market open, specifically when we're kind of monitoring some of that geopolitical overhang that does mark the market open? The opening trades, I should say, across Europe, right out of the bat, you are seeing the FTSE 100 kind of tagging that line, really straddling that line between positive and negative territory. The DAX right out of the gates, even over in Spain, the IBEX, you are seeing some positivity. So that future story is holding over. We are, of course, waiting for the French index to really open and get all those trades going. But remember, this is important as we talk about that geopolitical overhang. Is this that buy the dip moment for France as we wait to see what a coalition government may actually look like? Remember, in the last 24 hours, we have heard that France's Socialist Party reaching out to Emmanuel Macron's party to try to make some sort of movement together in terms of policy, of course, defeating Le Pen in the election. And, of course, the French index open now as well, higher by 0.2%. So, Tom, Lizzie, we are seeing green across the screen in those opening trades. Yeah, not catching up in terms of the losses that came through for the French market yesterday. We saw losses of, just over 1%. So the biggest drop
drop in the CAC current yesterday in about 3 weeks. Currently in positive territory, as you say, so making up for some portion of those losses. We continue to monitor, of course, how the politics changes and adjusts over in France. Across your sectors, basic resources, as expected, down 0.2%, one of the biggest losers so far. Healthcare also taking a very modest knock, down 0.1% in terms of healthcare. Energy also slightly lower. Healthcare now marginally in positive territory. Top of the list, though, the gains coming through for the auto sector. Interestingly, given the challenges of VW, up 0.8%. And on VW, given the adjustments that we're seeing, currently actually up 1.5% on VW. So to what extent some of the slower demand around EVs have been priced in already. Rio Tinto, given the copper and iron ore prices and the softness there, currently down 0.7%, guys.
Yeah, we'll talk about IAG as well. You mentioned VW higher by 1.5%. IAG is higher by about 4%. We call that double upgrade over from Morgan Stanley. Joe Easton had warned about that as well. Even Maersk higher by 3%, even talking about some of those shipping stories as well. So you are seeing some of those early moves. But again, I've really got my eye on the French index here because, again, you are seeing the same underperformers that you've seen in the last couple of sessions. Total, for example, continuing to weigh the entire Stock 600 down.
Yeah, but you've got about 3/4 of sectors in positive territory this morning on the Stock 600. You talked about the losers, Tom. You've got autos and parts leading the gains. As you say, Volkswagen now up 1.2% this morning. Retail just straggling behind, up 0.7%. Travel and leisure just behind that. This is at the open.
Yeah, so lots to digest. We're going to see how that all shakes out. In the meantime, let's go macro again, because, of course, this is coming off of really hearing from Chair Powell, his testimony in Congress. I was curious about what he said around the risks that are still in this market. Take a listen to what he had to say.
This is a risk that has been with us and will be with us for some time, probably for years. And banks need to be, honestly assessing what their risk is. They need to be assured that they have the capital and the liquidity and the systems in place to manage this risk.
All right, Christian Muller-Glissman, head of asset allocation research over at Goldman Sachs, joins us around the table this morning. A pleasure to have you on the brand new set, by the way. Good morning. I want to pick up where Jay Powell left off yesterday. Of course, he talked a lot about labor markets continuing to be a risk, inflation coming down, but still something we're wondering, kind of sticking to this usual playbook that he tends to say, not only in Congress, but to the broader media. This is, I think, the first time I've heard him talk about an ongoing risk, especially when it comes to the CRE market. Would you agree that this is an ongoing risk and overhang, perhaps, when it comes to the states?
I think definitely. It's been going on for a long time. It's been very controlled and very insulated, so there hasn't been any spillover so far. This is, I guess, why he speaks about the banks, because that's an obvious spillover channel. But I think we're dealing with a higher cost of capital and a lot of places in real estate, they're still adjusting to that. And we're dealing with these structural headwinds from work from home. So I think there's definitely a lingering issue. It's a financial imbalance that's unwinding, that's being dealt with. There have been significant write-downs already. The idea would be that it's gradual, that it's controlled and stays insulated. But I think you make a very good point. I think Powell is talking much more two-sided. I think it's a shift away from managing inflation risk solely to also acknowledging growth risks and in general acknowledging the weaker macro data that we've had in the US in the last few weeks. So I think it's pointing more towards cuts than in a long time.
Weaker macro data, but still far more resilient than data you're seeing in other parts of the world, which I think almost brings the focus, at least in recent weeks, to the politics of it all, and specifically the policy measures. We're 6 months away, 3.5 months away from the U.S. election, but 6 months away from another debt ceiling kind of I want to call it a trust moment, but this is the European in me starting to learn that. But the point is, they're going to hit the debt ceiling again in the States in January of 2025. We're already seeing panic in the bond markets around how France, the UK, arguably Germany, is handling their budgets as well. How do you price that in? How do you hedge it?
Yeah, I mean, it's true that we have this lingering fiscal risk premium. We're still trying to understand how the market will, over time, price that. Term premia are low, yield curves are flat. I think the challenge about getting the yield curve steeper, it's very difficult to do that with a bearish narrative.
Right.
We found this in the past. The summer tried that in the summer of last year. The market tried it in the summer of last year. And we found that it became self-defeating because you pushed up rates too much, too fast. And if there's no growth behind it, it's very tough. So there's two ways to get the yield curve steeper. One of them is get cuts and the back end just doesn't react. or you have a very bullish growth narrative. And I think the kind of cuts is probably going to be the most important driver. So we will build that fiscal risk premium in the next quarters, in the next years, as the central bank is cutting rates in the front end. Or if we do learn that AI in the next 2 to 3 years is an enormous driver of productivity growth, that could drive a bit more bear steepening in steps. But I think the fiscal risk premium, to price that now in the next 6 months or so, is very difficult for the market, and especially in the face of weaker data, because that really anchors rates and that to some extent drives downside risk. So you don't want to position necessarily for much higher rates from here, considering the weaker data right now.
Careful, Christian. You sound a lot like Larry Fink over at BlackRock. Tom, it's interesting that he's talking about the steepener trade, especially in light of the fiscal deficit, because when we talk about the Trump trade, it's the same trade, even though it's two different fundamental stories, arguably.
And the question is as to whether or not the Trump trade, or at least the prospect of a Trump presidency, is inflationary, whether or not the markets have really taken account of that, given you have to take him at least partly at his word when he comes through with his policies, wanting to drastically cut down on immigration. That's inflationary. The 10% tariffs, the tax cuts, stimulatory. So to what extent is there complacency in these markets about the prospects of a Trump president?
I think, we're entering the hot phase. I think we know that the market is struggling to price political risk too early on, because political risk in general is something that, as investors, you don't want to put too much weight on. You don't want to shift your portfolio around too much unless you get a bit closer to the event. It's very tough to position around the event. It's very tough to understand the policies before they actually get announced.
And yet France reminds you that you can get burnt if you don't position.
Absolutely. And I think what we've seen from clients is definitely a preference for the dollar, because the dollar seems to be a bit of a winner in a lot of the scenarios. If you get like a reflationary shift via lower taxes, if you get trade tariffs, if you get like geopolitical uncertainty picking up, the dollar has been popular for people to kind of diversify portfolios, you could say. And a lot of people are long the dollar anyhow via their equity exposure, which is still a large proportion. But I think we're definitely going more in the weeds. In the last few weeks, there's been a big focus on the tariffs. And our economists have done some very detailed work on that. And it starts to open more questions than answers. For example, if you introduce like a 10% blanket tariff, they're saying it could add like 100 basis points to headline CPI. But at the same time, it could actually stagnate or kind of subtract a bit of growth, like 40, 50 basis points. So it's like a stagflationary shock. And then the question is, what actually dominates? Is it the inflation that pushes up rates, or is it actually the growth impact that lowers rates? And that's not 100% clear to us, because you could argue if it comes at a time where the US economy is already growing a bit less, you could say that the growth impact dominates. So there's a few question marks, but what we've been recently focused on is inflation pricing. To potentially look at break-even inflation as a hedge if you're worried about these tariffs. And the market only 2 weeks ago started to price higher break-even inflation.
OK, they're really interesting questions to be asking, even if you're not acting on them yet because of all of the uncertainty around the politics and the geopolitics. But then for now, where does it leave the 60-40 split in your portfolio?
I think, listen, as you might remember, we've been quite worried about 60-40 at the end of 2021. We wrote the Balanced Bear research. We said, be careful about that very well-known, well-positioned type strategy. But in the last year or so, we started to go back to 60-40 as a starting point. But we said you have to be a bit smarter this time around, because you're dealing with two major uncertainties. On the one hand, you have higher inflation risk and inflation volatility. On the other hand, you have this productivity growth coming from AI, GLP-1. And that often is the case after large inflation surges, that economies and companies try to become more productive. So you need to reflect that. So what we've been saying is the optimal portfolio is more like 1/3 equity with a tilt towards growth, 1/3 bonds, and 1/3 real assets. And within the real assets, you can take 20% or so back into equity, because equity can be real assets, but you need to buy companies with pricing power, maybe exposed to commodities, maybe infrastructure. And then you take the rest of the real assets, the 10% or so, and put it into TIPS, which actually offer you quite high real yields right now. Break-evens are reasonably low. So you end up again with 60-40, but you have something that's robust for the big risks that we're facing. OK, 60-40, but a bit more complex. It's a very different view from Rhian-Mari, who we had on in that seat just a few minutes ago. But you mentioned AI as well. Should you, or how do you diversify around US tech? Yeah, it's become more difficult. I think our team, they've looked a lot at the different phases. So you go from the CapEx, the infrastructure, which, NVIDIA, and then you go towards the next steps, like maybe the users, then the beneficiaries of using, and so on. And over time, you need to kind of think about finding in these phases opportunities. You need to broaden out your growth tilt. You need to broaden out your AI tilts. But I agree with you that you want to be a bit careful to make it all about AI. I think, for example, we've been quite interested in healthcare recently. You've got to think about the next steps. If you do actually have AI being a success, you could see the healthcare industry or other industries that do very mechanical type analytical things benefit and gain scale. So we've been increasingly focusing on so-called X-tech compounding opportunities, like not going just for tech, but looking for industries that are already having good profitability, having good cash flow, and they might be able to reinvest partially into AI and get more scale to their business. But I think it's all about broader diversification and trying to mitigate the concentration. I know it's tough because these stocks are so important, and if you go away too much from them, it kind of exposes you to underperformance. But I think over the next few years, that will be a really important shift that investors have to do.
So that's the fundamental story. But in your portfolio, in that breakdown that you just talked about going long dollar, you talked about your tips and even break-evens as a hedge as well. I'm looking at money market funds right now that are holding still record cash that in the front end of the curve. A lot of that is policy-driven, of course. But there is an argument in the market, a bull case for a stock market that has gone into pretty extreme valuations. I think that's fair consensus to say that so much of these funds that are sitting in long dollar positioning or money market funds could then at some point be deployed to the stock market, pushing it to even further highs. What do you say to that?
I'm not sure. I'm a bit skeptical on that. I mean, if you look at the household allocation to equity in the US, it's already at an all-time high.
Yeah.
And guess what's at the lowest allocation ever for US households is US Treasuries. I would actually argue a lot of that money market funds, assets under management, they need to absorb the bond supply that we're facing in the next few years.
Yeah.
And that's a natural thing. If you have a higher debt to GDP ratio, either the households or the central banks need to absorb that. And I think central banks have scope with inflation normalizing in our base case to kind of absorb, but they obviously like to absorb bond supply only in crises, like via QE.
Yeah.
So the primary absorption channel and the most stable one, as Japan has shown, which has a very high debt to GDP ratio, and households own a lot of the bonds.
Yeah.
The most stable absorption channel is the households. So I would say a lot of these money market funds, especially if they're from households, they will, as the yield curve steepens, they will extend duration and absorb bond supply. Not much of that might go to equity.
So we're hearing about this pool of excess bond supply, arguably, whether it's coming from U.S. households not absorbing it, or whether it's even coming from foreign demand, for example. We were talking about the fund flow coming out of China and into Chinese bonds, for example. But how does that square with some of the data we're seeing in terms of Treasury liquidity specifically, where the yield error has just been on a 6-month kind of climb? How do you square those two?
Yeah, I mean, listen, I think we have obviously the change in QT, and that has helped put liquidity back into the system. Tax receipts have been a bit bigger as well. I think net, you're dealing with enough liquidity as it seems. Currently, there's not a liquidity concern. As you were mentioning, there's a lot of money market funds as well.
Yeah.
So I think to me, the kind of technical aspects of liquidity are less concerning. The most concerning thing is still, as you were saying, fiscal risk premium, term premium being too low, and that occasionally can scare the market, and you have these episodes where the curve bear steepens. We don't think that these type of episodes are likely to be sustained. They will be self-defeating because you need growth to properly bear steepen, and it's much easier to bull steepen. So we're still leaning with that. But it does expose you to occasional rates volatility. And rates volatility actually has started picking up again, showing you the market is still not completely willing to fade what we've been through in the last 2 years.
And, of course, we're waiting for the rates volatility to show up in the FX volatility, which still feels very, very stagnant at the moment. Christian Muller-Glissman, we have to leave it there, the head of asset allocation research at Goldman Sachs, nerding out around the breakfast table this morning. We thank you so much. In the meantime, a quick check on the Guy Johnson Sensational Six. I got to give him credit here. Talking about the heavyweights in this region. You aren't seeing many trades coming out of Schneider Electric at the moment, but you are seeing some outperformance coming in Ferrari, higher by about 0.4%. The rest of the companies, Nestle, Novo Nordisk, even ASML, only higher by about 1 to 0.2% in either direction. So it feels like maybe the large caps, dare I jinx it, a little bit of a snooze fest. Let's see if there's more excitement in some of the other individual stocks on the move. Joe Easton has that for us. Joe?
So one place where there is excitement today is in the shipping space. This Hapag-Lloyd forecast upping their guidance by around €1 billion really is feeding into positivity in the market. Hapag rising 6%, AP Moller Maersk gaining 1.4%. We're also seeing moves in Canaan and DSV, some of the other big shipping companies today. I have just read a contrarian call from analysts over at Warburg, though, and they say that potentially if the Houthi rebel attacks stop in the Red Sea this year, that would then see the shipping rates collapse, and this might actually reverse in terms of the earnings. But for the moment, it's positivity in the shipping companies today. Another area of positivity is defence stocks. There's a company out of Norway giving a pretty positive update. That's Kongsberg gaining 7%, the best performing stock on the Stock 600 this morning. They make defence systems for the Norwegian army and also around Scandinavia as well, and that is a bit of a positive one. The defence peers, meanwhile, they were higher when I punched them in earlier, but they are now coming down a bit. We have had comments, of course, from Joe Biden about Ukraine and also the situation over in the Middle East as well. So keep an eye on that sector today. Then in terms of autos, this one perhaps one of the more surprising moves, although analysts were a bit mixed on their views. Volkswagen actually slightly higher today. Analysts said that downgrade to their guidance was potentially priced in, given they knew that this factory over in Brussels wasn't actually as strong as they had expected before. That's an EV plant that they are shutting down, and they are booking a charge, but that probably priced in. Brought up Porsche as well, because Porsche still own around 32% of Volkswagen, so keep an eye on those two today. One bit of M&A to bring you out of Spain today is Engas. Now, this company is selling a big stake to Blackstone Private Equity, selling that off. They are a company that move natural gas around Europe, and they're offloading a chunk of that. But it wasn't a huge premium to me. It was pretty much in line with where that was valued yesterday. So we're only up 4% for Engas over in Madrid, but it is moving nonetheless. Over on your airlines, we had these on stocks to watch. Now, they have moved the market. Morgan Stanley double upgrading IAG, and that one is up 3.3%. They say that the pricing outlook is best for the British Airways owner, and they downgrade Lufthansa, which is more exposed to a bit of short haul and actually more competitive long haul markets, according to the company. Finally, following the election last week in the UK, we get an upgrade for Next. Getting that one right. That is Next. That's upgraded over at Citi. They go from sell to neutral. They say the UK consumer is more optimistic, a bit more stability following the new government coming in. That might start feeding into the economy. The High Street Bellwether Next upgraded to neutral from sell, and that is up 1.3% in London today.
All right, Joe Easton from our equities team, we thank you. But the call that we really want from you, Joe, is who's going to win the football tonight?
Well, I just think we keep it tight, play for 0-0, get to penalties, and nobody's going to beat us on penalties. They're going to be fearful with those penalties.
Yeah, fair enough. OK. No, that's a grim out. I mean, yeah, OK, we win on penalties. So we just continue to grind. We continue to grind it out. Keep it tight.
No faith from Joe Easton. We're going to get back to the geopolitics next. We're going to be bringing you the latest from the NATO summit in Washington. You've had the alliance pledging more air defence equipment for Ukraine, all in patience from Zelensky, and all eyes on Biden as well. But more on that is coming up next. This is Bloomberg.
Welcome back to the opening trade. We are 22 minutes into Wednesday's session. European stocks grinding out some modest gains of just shy of 0.2% so far in the session. To the geopolitics now. NATO has opened its summit in Washington by promising 5 long-range air defence systems for Ukraine. The fresh show of support comes even as the alliance resists offering Kyiv a clear path towards membership.
The United States will make sure that when we export critical air defense interceptors, Ukraine goes to the front of the line. That will get this assistance before anyone else gets it. All told, Ukraine will receive hundreds of additional interceptors over the next year, helping protect Ukrainian cities against Russian missiles.
OK, joining us for more is Bloomberg's Brussels bureau chief Kevin Whitelaw. Kevin, does this support Does the detail that we got out of Washington so far at this NATO summit, does it move the dial for Ukraine?
Look, I mean, Ukraine needs every last little bit of air defenses it can get. We saw that again this week when Russian missiles got through and obviously killed a number of people, including an attack on a children's hospital. So Ukraine is looking for everything it can get. One hitch with what was announced yesterday is a bunch of those systems had already been announced by countries previously. So this is kind of, in part, a repackaging of things that had been coming through. But they were all coming through for this summit. So Ukraine will be happy to get those. It needs those. The next question then becomes, is the ammunition supply going to be regularized? And what kinds of restrictions are they going to be placed under? For all the different offensive weapon systems, Ukraine's obviously eager to be able to hit inside Russia from where some of the attacks are being launched. But different countries have different restrictions on how far inside Russia they can use those weapons.
So, Kevin, putting kind of the defense or historic donation, as Joe Biden called it, aside for a second, talk to us about the dynamics at the summit itself. Of course, we know this is Keir Starmer's first international appearance on the stage since becoming prime minister here in the UK. We know Viktor Orban has been on a global tour as well. Biden's age is taking headlines. Who are the power players here right now at the summit?
It's a good question. I mean, I think obviously Keir Starmer comes in as one of the sort of ones who's riding high at home. He's the new face. Everyone's going to want to meet him. And he sort of comes in with a little more sort of political strength than really almost any of the other major leaders there. Emmanuel Macron is obviously a little distracted by what's going on at home. I still think, really, as you say, all eyes are going to be on Biden. Everyone's going to be trying to figure out, how is he doing? What's his health like? Is there any chance he can win re-election? Is there any chance he's going to step aside? For Ukraine, that is an existential question because the prospect of a Donald Trump victory is something they need to be extremely concerned about when it comes to the continued supply of U.S. aid, U.S. weapons, U.S. money to Ukraine.
And Kevin, you mentioned Keir Starmer. He's playing the hawk, but how long can he get away without giving the detail on when that 2.5% of GDP defence spending target will actually be met?
I mean, he has only been in office for a handful of days, so he probably has a little bit of time to try to lay out a plan. But, I think like with all these things, he's going to have to strike fast before, some of that political momentum starts to fade. So I think everyone's going to be looking for those to see whether he's able to achieve that. But he probably has at least a little bit of time to get that done.
Well, you can forgive my impatience. It's shared by Volodymyr Zelensky, of course. Thanks to Bloomberg's Brussels bureau chief, Kevin Whitelaw, for the analysis of the NATO summit, which is, of course, ongoing in Washington. 32 leaders from around the world there. But coming up on the opening trade, you do not want to miss our interview with Rhian-Mari Thomas. She's CEO of the UK government-backed Green Finance Initiative and chair of the National Wealth Fund Task Force, which, of course, is expected to be crucial to Keir Starmer's vision to grow the UK economy. That conversation coming up next. This is Bloomberg.
Welcome back. This is the opening trade. We are 30 minutes into today's session. European stocks across the benchmark giving up some of the earlier gains. The UK, though, still in positive territory, with the FTSE 100 adding 15 points, up 0.2%. But the CAC 40 has turned negative again after the losses of yesterday, down 17 points, 0.2%. We continue, of course, to watch how the debate follows in terms of trying to put together a government in France. We're still a long way from that, it seems. Across the sectors in Europe, personal care, telecoms, real estate, all near the top of the list, but gains of just 5 to 0.6%. Nothing really significant on a sector-by-sector basis. But on the list, you've got basic resources, chemicals and banks. Now, some of the individual names, we're looking at, of course, what's happening with VW. That's actually in positive territory. Volvo, though, down 1.5%. Logitech taking a hit of around 2%. Barratt Developments here in the UK, one of the hand brothers, currently down close to 3%. Gains, though, coming through for the likes of Technic Energies and Travis Perkins, also in the real estate sector. Very different picture, though, up 3.8%. Now, talking of the UK, there is a task force that's being put together. There's a national wealth fund that's part of the plan with this new government. I know you've been looking into this, Lizzie, the significance and to what extent our firepower around this national wealth fund has been constrained by the fiscal picture that we face. Talk to us about what's being considered, what the government's trying to put together, why it's significant, how it ties into the green revolution, all that stuff.
Yeah, the whole point of this is that the government's going to stump up about £7 billion, the new Labour government, of course, and then it wants to try and attract private investment to try and build jobs, green jobs, and then boost growth. And economic growth, of course, the key theme for this government. And the point is that that growth would spare the Chancellor, Rachel Reeves, a difficult choice between tax rises and spending cuts. That's the hope. But you've had this task force on the National Wealth Fund making a report, doing a review at how best to run this thing, and it's concluded that even if they stump up £7 billion, it's going to leave a £35 to £57 billion gap to find by 2030 if it wants to hit its goals. So interesting how Labour can bridge that gap, if at all, when, as you say, it is so fiscally constrained. And we're going to be speaking to the chair of the task force, who is also the CEO of the Green Finance Institute, Rhian-Mari about this. She says that even if the clear policy direction is set, there are still going to be projects that are left unfunded because of the risk that it takes on investors to actually get these projects off the ground. So the public-private debate back in focus, as it was very much in the 90s.
Yeah, flashback to the 90s and PPI. Let's bring in Rhian-Mari then at this point, CEO of the UK government-backed Green Finance Initiative and chair of that National Wealth Fund task force. Really great to get you on the show, Rhian. Thanks for joining us. Let's start with that question then. The report suggesting that about £57 billion is needed between now and 2030 to kind of implement the changes we need to see, far more than what the government's got at hand, £7.3 billion or thereabouts. Where do you see the rest of that capital coming from?
So thank you so much for having me on. 7.3 is obviously a significant figure, especially given the fiscal headroom we have at the moment. But the answer to your question is this is all about private capital mobilisation. So the 7.3 is very much a strong signal of the industries that the current government want to see growing, the new industries of the future. But as you say, 7.3 pales into insignificance compared to the 50 billion that the Climate Change Committee has said we're going to need, and 57 billion, I think the Bloomberg numbers say we're going to need per annum. So the key here, this is all far too big for the public purse. Public purse needs to be used in order to catalyse private capital. And that is why the National Wealth Fund has been set up. And I think we should probably think of it more as a sovereign-backed green catalytic fund, although I think it might be a little too late to change the name at this point. But a catalytic fund that's able to provide guarantees, that's able to provide off-take support, that's revenue certainty mechanisms that will be able to bring that private capital to bear.
OK, the Green Catalytic Fund. There we go. That's the headline. You've just rebranded it for us, Rhian-Mari. In terms of getting that capital on board then, and you say, look, the state funding is going to be that catalyst to bring in the private investors, give that assurance that these are going to be less risky bets. What are you hearing from private capital? How much appetite is up there? Because there is an urgency around this.
Absolutely. So, everything that we've put into the report, into recommendations that led to the launch yesterday, was all about focusing on private capital mobilisation. And obviously, the task force comprised leaders of a number of leading banks, leading pension funds and large investors. And we consulted more broadly, obviously, than just the task force members themselves. The private markets are, in theory and in principle, committed to investing in these industries of the future through their net zero targets. But as I think your colleague was mentioning earlier, there are still risks, particularly when it comes to first-of-a-kind technologies and some of these larger infrastructure projects that really do need to be for the government's account in order for us to actually get over that initial investment hurdle. We have a fantastic example in the UK of how we did this a number of years ago with building the green offshore wind industry, which now employs tens of thousands and is financed through institutional investment, even though initially it was seed funded through the Green Investment Bank, which is obviously a government-backed vehicle.
OK, so you may need to give confidence to private investors to go into those sectors. Just coming back to that £7.3 billion figure, Rhian-Mari, when you compare that to the oodles of cash that sovereign wealth funds in the Middle East and the Nordics are throwing at these projects, how does the UK even compete on the global investing stage?
And I think, and you're right to make that comparison, but I think in order to attract finance, it isn't purely around the actual catalytic capital that government's putting forward. It's also to do with planning and electrification of the grid and meeting the skills gap and making sure that we've got the supply chains in order. And, already we're just seeing in the first few days of this new Labour government an intention to tackle a number of those things. And so this is a powerful signal in order to mobilise more of the private capital, but it cannot be done in isolation. We need that holistic approach.
And Tom mentioned the concerns around PFI, the Private Finance Initiative back in the 1990s. It had this bad rep for being bad value for taxpayers. How do you stop this becoming PFI 2.0 and having all that reputational image as well?
Well, I think one, learning the lessons of the past is obviously a key thing. And secondly, making sure that we've got the private investors and we've got the right caliber of people involved right from the outset, people that have got experience of investing in these types of industries, into infrastructure, into first of a kind, that have done that perhaps in other jurisdictions. But, this is genuinely a call for real collaboration between the public sector and the private sector, so that we can create these new industries, create new asset classes, and create opportunities for investment. I think it's a pretty exciting day.
So much of that, though, is based on the idea that private funding is actually going to come through. When Rhian-Mari, I have to mention that when we look at the economics of this all, this is only works. Private markets only work and are only thriving right now because the consumer globally is looking very resilient. There are risks to that, and even in the private capital markets, there is real concern about whether all that snaps in just 6 months' time. How can you be so sure that that funding is going to be there in 6 months' time?
So you're right. There are obviously geopolitical and macroeconomic concerns that will impact all investment. But what we do know is against that backdrop, there is now the race to net zero has become a race for investment, as we've seen. In the US, 22% increase in clean energy investments over the last year, and obviously the 700 billion or so that Bloomberg New Energy Finance have indicated that China spent on this agenda last year. And you see the European Union with their Green Deal also making sure that this is now a race for those industries, for those jobs, for the route to prosperity. So your concerns are absolutely valid, but sitting back and not actually trying to take these proactive steps to actually attract that capital into these industries, into the UK, I'm afraid is not an option.
What about attracting talent to the NWF? How are you going to make sure that they get the calibre of people needed to get this mission over the line? Has the government said that they're going to relax the pay and procurement constraints to get those people in?
Well, you've seen that is one of the recommendations that is in the report that was put forward to government. Obviously, having put our recommendations in that were very, very warmly received by the Chancellor and by the Secretary of State in the Department of Energy Security and Net Zero. We're hoping that all our recommendations get taken forward wholesale, and that is in there. Obviously, the next phase of this work is Treasury officials and those around the Chancellor will need to implement those recommendations and stand up the fund. But you're absolutely right, and that was one of the recommendations that came out very strongly from the task force.
OK, Rhian-Mari Thomas, Chief Executive of the Green Finance Institute. Great to have you on the programme as we look towards that policy agenda of the Labour government, hitting the ground running with an absolute blitz of policies in just the past few days. We thank you for coming up on the opening trade. You do not want to miss our next interview. It's with Matteo Renzi, the former Italian Prime Minister. That's coming up next. This is Bloomberg.
Welcome back to the opening trade. We're about 43 minutes into today's session, seeing a little bit of a mixed picture when you look at what the indexes are doing. Some outperformance right here in the K and the FTSE 100. But it feels like right now, as we're navigating some of these policy implications, even the monetary policy as well, it really is the geopolitics that are an overhang over it all. We have the perfect guest to talk about just that. Joining us now, Matteo Renzi, former Italian Prime Minister and leader of centrist political party Italia Viva. A pleasure to have you around the table this morning. Look, I'm tempted to ask you about the States, but we'll put a pin in that for just a moment. I want to talk about Italian spreads at the moment. They have historically underperformed the likes of France, Spain, Germany, of course. Right now, they're doing really, really well. How much of that is a credit to Giorgia Meloni?
I believe there is a stability in Italy, and that is very strange because usually Italy was the worst country for stability in the past, and now paradoxically we have a chaos in France, an instability in a lot of European countries, and Italy is good. That is a good message for markets. I'm at opposition to Giorgia Meloni. She's a leader of a different party, but I respect my country, and I think also for investors, this is a good time to invest in Italy and also to move residency. Fiscal residents, a lot of fiscal residents decide to move from different countries and to move to Roma. Then I will continue to fight against Georgia in my country, but as Italian, I'm very happy about the stability of my country.
I mean, you would say that, wouldn't you? You're Italian. Let's talk then about the fact that Italy is doing so well and is that beacon of stability at the moment, relative stability, I will say. I feel like it's putting Giorgia Meloni on an international stage, giving her a lot more say in international politics than maybe traditionally in the past. I'm curious when you compare that to the likes of France and what's going on with Emmanuel Macron. Is France then losing its position on the international stage because of its finances?
No, I think not. We have to be very frank and honest. That is a little exaggerated. Emmanuel Macron won his gamble. A very complicated, very chaotic situation in France, but Emmanuel Macron decided to accelerate the early elections because that was the only solution for him. Because in case of without this decision, the risk for Macron was lose the majority in the Assemblée Nationale in September for a complicated rules of the French situation. So now Macron won with a very Machiavellic, if we think about Italian history, it's a very Machiavellic operation. It was great in that. Now there is a government, not easy to do, but there is Emmanuel Macron very strong in the international stage. For Giorgia Meloni, the problem, she have an alliance in Europe very wrong. And for that, she was out of the top jobs in the European Commission debate. So she's stable in Italy, but she's not so strong and relevant in Europe.
Has she charted a path, though, Meloni, for the right? She's shown how it can be done. She's been elected with that strong mandate domestically in Italy, with that right-wing rhetoric and those policies. Then she's adjusted. She has shown the playbook for how the right can follow.
I believe in Europe, right lost our traditional family, because, you know, Orban and other friends of Orban decide to create a new parliamentarian group. And Meloni was isolated, absolutely alone. It's interesting to understand why that happened. That happened because Orban, Salvini, Vox and others have a platform very near to Russian positions, and Meloni maintained a position very pro-USA and pro-Western alliance. So I think the decision of Giorgia Meloni in this case is absolutely correct. But today, if you look at the numbers of European Parliament, the far right is so divided, and I believe if you look at the results of European election, a lot of journalists and also politicians, now it's time of far-right new government. No, in Europe, everything remains exactly as last time.
You don't feel lonely as a centrist?
The centrists, it's complicated. Centrism is the key to win the elections. Also in the time of extremists, also in the time of populism and sovereignism. But the problem is the way. For example, in UK, When Starmer decided to have a different platform with respect to Jeremy Corbyn or Ed Miliband, he won election.
34% of the vote. Almost
Yes.
70% of the vote went elsewhere.
And the reason of victory in UK is the change of platform for Labour, and at the same time, I think the presence of Nigel Farage in a position who reduce the number of votes for Conservative Party. But that depends on the single electoral law. And for that it's important to be Machiavellic, because if Emmanuel Macron won his gamble is exactly because he used the second round. In the first round, Marine Le Pen won, but in the French system it's different. Meloni won in Italy because there is only one system. In case of 2 rounds of election, Meloni lost last election. So it's very complicated for the people who stay in, who look the politics, but every choice of politician today have to be focused on the single institutional instruments of the single country. And we don't open for the moment the door of America election and America.
Oh, don't worry, we'll get there.
We'll get to that door in just a
Right.
moment. But just on Keir Starmer, how confident are you in his promises on growth, this 2.5% growth target? You've been hanging out with Tony Blair. Do you think that Starmer can be Tony Blair Mark II?
I believe Tony Blair was one of the greatest leaders around the world in terms of delivery and capacity to have a vision for the future of his country with a new Labour, and a source of inspiration for a lot of leaders. Myself and a lot of other leaders try to copy the experience of New Labour between 1997 to 2008. For Starmer, it's not easy, but yesterday Tony Blair Institute organized a very good conference called Future Britain, and in that conference Blair tried to explain some possible opportunities to increase GDP and to use artificial intelligence and in general technology as the key instrument to change productivity, to invest in the future. Technology is not an instrument of fear. Technology is the best ally we have as politicians.
But can it get the growth?
I believe artificial intelligence could be the key for the growth, for the employment. I believe it's very interesting the discussion about healthcare, particularly in UK, but not only in UK, because with a long expectation of life that is beautiful, that is good, the change in the expectation of life, we have to invest in a new healthcare system. But also artificial intelligence and in general innovation have to change the modality of use healthcare and to manage healthcare. At the same time, we have a great necessity to invest in new technologies and create an ecosystem for venture capital, for innovation. So I believe the growth of GDP is possible, is a great ambition plan. In general, I think, particularly this part of the world, Europe and UK, have a problem with the crisis of demography, more in Italy, more in Germany. In Italy, we are in front of not a decline of demography, a collapse. If you think it is without benchmark possible. When I was born in 1975, 1.1 million of new babies born every day. Now, 0.4 million. 1.1 million.
Are you suggesting more immigration for Italy is needed?
I believe the real problem of Italy is not immigration. Also, if the far right continue to push in this direction, the problem is immigration. The people who leave Italy, the young people who stay now in London, who stay in the United States, after graduation, after they finish all the studies, they decided to leave Italy. That is our problem today. And I think we have to change the modality to give the message about Italy. Italy have to become a lab and not a museum.
But the immigration conversation that you're talking about, the demographic conversation you're talking about, is something that applies in every part of the world, including the United States. You've been very vocal, and I have to bring it back to this conversation for time. You've been very vocal about what the possible result of this U.S. election may look like. You've worked with Barack Obama. You've worked with Joe Biden in your time in office as well. You've publicly said that Joe Biden doesn't have what it takes to win this election. Who does? I have great
friendship and admiration for Joe Biden, for his personal life.
Yeah.
I believe he was a great man in terms of public service. I have I pay a tribute of gratitude for the job he did when I was Prime Minister and he was Vice President. So I'm friend of Joe Biden. I think that it's time for him to leave because we know, particularly after the terrible debate on CNN 10 days ago, 2 weeks ago, I think it's clear the message. The people don't look the reality, don't look the facts, don't look the quotes of President Trump. The people look the situation, the physical situation of Joe Biden.
But
and for that, I think he have to leave.
Who does he leave in favor of? Kamala Harris, Gavin Newsom? Is there a name that you would replace him with?
I think I'm the last one, okay, to give him a name. But if you ask me about a skill and an idea, I think for Democrats, in case of in case of not new candidature of President Biden, the only possibility, for my humble opinion, is choice a man or woman out of the box. Not Kamala, because also polls
show...
So
a business leader, then, you're
maybe.
saying.
Why not?
Like a Democratic version of Trump.
If you think about, if you find a leader of financial world, business world, also governor, able to give a message very, very strong, I'm ready to defeat Trump in economy, that could be a great asset for the electoral campaign. Of course, we have 5 weeks before the convention in Chicago of Democrat. And I'm not sure that could be possible. I'm not sure
but
that
you specified the economy. I'm putting you on the spot here, 20 seconds. Would Trump be good for the economy?
Trump, of course, the problem of Trump, the only thing predictable with Trump is unpredictable, his presidency. Because Trump is able to do every type of agreement.
Yeah.
You know what he did in the foreign politics. He's ready to do everything he considers right in his mind. So I'm not in condition to have a prediction, but I believe nobody could predict what Trump could do. And that is not necessarily a good thing.
Matteo Renzi, will leave it there. Former Italian Prime Minister and leader of centrist political party Italia Viva, giving us his thoughts on the geopolitics around the world. That does it for the opening trade. The Pulse is up next. This is Bloomberg.